JP Morgan's annual guide to retirement shows that missing just the 10 best market days in a 20-year period cuts your returns by more than half. That's exactly what panic selling does. Today, why the best days cluster right after the worst, and the 5 rules that stop the sell button. By the end of this video, you will know the 5 rules that mathematically protect your portfolio from the single most expensive mistake in long-term investing: missing the 10 best market days in under 9 minutes. Panic selling means selling investments because the price has dropped and you're scared. It feels protective. It's the opposite. The 1995 Bernardsey and Thaler paper on myopic loss aversion, published in the Quarterly Journal of Economics, documented this directly. Investors who see drawdowns more often take less risk than is optimal, sell at the wrong time, and end up with lower long-term returns. The same paper showed why this isn't a discipline problem. It's a feature of how the human brain processes losses. We feel a $100 drop about twice as intensely as a $100 gain. So when the market is red, the brain screams, "Do something." Selling feels like doing something. It's almost always the wrong something. Here's the math that should be taught in every school. JP Morgan Asset Management's annual guide to retirement runs this analysis every year. A $10,000 investment in the S&P 500 from 2003 to 2022, fully invested the whole time, grew to about $64,000. If you missed just the 10 best market days in that 20-year window, you ended with about $29,000. Less than half. Missed the 20 best days, you ended with about $17,000. Missed the 30 best days, around $11,000, barely above where you started. Why does missing 10 days matter so much over 20 years? Because the best days almost always cluster right after the worst days. Long-run data on globally diversified indexes like the MSCI World shows the same pattern outside the US. Recovery days follow crash days. When you panic sell on a bad day, you usually miss the rebound. Markets don't warn you before they bounce. Rule 1. Crashes aren't a sign something is wrong. They're a feature. A historical review of global equity indexes across S&P Dow Jones Indices and MSCI World Series finds roughly one drawdown of 10% plus per year on average, one drawdown of 20% plus every 3 to 4 years, and one drawdown of 30% plus about once a decade. None of these are unusual. All of them have always recovered. Selling because the market dropped 30% is selling because something completely normal happened. Rule 2. Decide what you'll do when a market drops 30% before it drops 30%. The 2004 Thaler and Bernardsey Save More Tomorrow paper documented why pre-commitment works. Removing the in-the-moment decision is more powerful than any in-the-moment willpower. The pre-committed rule for a long-term investor should be simple. Keep buying through the drop, do not sell. Write it down. Tape it to your monitor. When the crash comes, the rule is already made. You're just executing it. Quick reminder of why this matters. By the end of this video, you'll have the 5 rules that mathematically protect you from the single most expensive mistake in personal investing, including Rule 5, which is the part most investors learn only after losing a lot of money. 2 rules to go. The 1995 Bernardsey and Thaler paper showed it directly. Investors who evaluated their portfolios less often took more optimal long-run risk and earned higher long-term returns. Daily checking samples the random noise. Quarterly checking samples the signal. Set 4 check dates a year. First day of each season works well. Between those dates, the app stays closed. The crash you didn't see can't trigger the sale you'd regret. Rule 4. The 2004 Thaler and Bernardsey automation framework applies here too. Set up a monthly auto purchase of your long-term index fund. The auto buy executes during crashes, which is when you're getting more shares for each dollar. This is the part many beginners miss. A market crash isn't where the long-term investor loses money. It's where the long-term investor buys more shares cheaper. The auto buy doesn't care that the headlines are red. It just executes. Same monthly contribution, different decade horizon outcome. Because the months when you'd have hesitated to buy manually are exactly the months your auto buy was loading up at lower prices. Rule 5. The hardest to internalize. Compounding works whether you watch or not. It just needs your absence at the sell button. The richest investors aren't the ones who watched closest. They stayed longest. Warren Buffett's favorite holding period, forever. The 1995 Benartzi and Thaler framework explains why. The longer your evaluation window, the smaller the loss aversion effect, the closer to optimal your behavior gets. This is the kind of content I make every week. Clear, calm, no get-rich-quick. If that's how you want to learn money, you already know what to do. Two friends. Both invested $50,000 in a globally diversified index fund on January 1st, 2020. Both planned to hold for 20 years. Friend A watched the news. Saw the market drop 34% in March 2020. Sold half the position to protect capital. Waited 4 months to rebuy at higher prices. Year-end 2020. Portfolio worth about $42,000. Friend B never opened the app. The monthly auto buys executed straight through the crash, picking up extra shares at the bottom. Year-end 2020. Portfolio worth about $63,000. Two things drive that gap, and both are measurable. First, selling into the fall turned a paper loss into a realized one. Friend A sold half the position after a 34% drop, so that half was sitting in cash, not in the market for the recovery that followed. Second, that recovery was concentrated into a very small number of days. JP Morgan runs this analysis every year in its Guide to Retirement. Across a 20-year window, an investor who stayed fully invested finished with roughly twice the balance of one who missed just the 10 best trading days. 10 days, out of about 5,000. And those best days are not spread evenly. 7 of the 10 best days fell within 2 weeks of the 10 worst days. That is the trap. The days you most want to be absent from the market sit right beside the days you cannot afford to miss. Selling to escape the worst days is the most reliable way to also miss the best ones. Same starting capital, same fund, same 12 months, $21,000 gap, entirely from one button press in March 2020. The 5-rule panic sell prevention framework. 1. Understand that crashes are normal. Minus 20% every 3 to 4 years, minus 30% every decade. 2. Pre-commit your behavior in writing before the crash. 3. Reduce checking frequency, quarterly at most. 4. Automate buys, turn crashes into discounts. 5. Remember the compounding math runs whether you watch or not. That's the Start Here playlist complete. Go back to video 1, 7 money habits that are quietly keeping you broke, and watch the series again in 6 months. You will hear different things the second time.